Hello everyone and welcome to today's major markets update. Yesterday wasn't really sure about which way the market would go as a reaction to the economic data that came out today, the jobs report. I think I mentioned both jobs report and CPI data, but there was the jobs report. It's still a little too high according to the stock market, so we dropped. Literally, I could shake 6, 7 different Elliott Wave counts at the price section from last Friday's low to suggest that we could first pop and then drop, or drop instantly. So it was really up in the air. That's the limitations of Elliott Wave. No method is absolutely perfect in forecasting everything all the time, especially not on the shorter term. The more closer up we look, the more variable things become. It's a little bit like a quantum physics. Why? Because we're dealing with a stochastic, nonlinear, highly probabilistic market environment. So that's simply what we're dealing with. And let's then have a look at what we're trying to figure out. Now, remember, I always want to be cautious and I always want to rethink the current thinking on where am I wrong? Where am I wrong? And something is rotten in the state of Denmark. Not necessarily with the economy in the world and all those things, but with the wave count I'm tracking. So I wanted to present something where I go like, you know what, we might need a few more ups and downs before we are all said and done. This is not shifting the goalpost. This is making sure that we always allow for critical thinking. So please hang along with me. I'm only going to present the S&P 500 today. So here is the current wave count for the expanding leading diagonal that I'm tracking. We also have the B wave bounce here in August, and we simply had an A, a B, and now in wave C. Doesn't really matter for the downside projections in the current leg lower of the August high. It only has implications for the pending much larger multi-month bounce that is coming. It's coming, don't worry. We always get a big bounce before we get the next leg lower. And here is the wave count we've been tracking. Wave 1 down into the September 6 low, wave 2 up into the mid-September high, and now in wave 4 that has most likely completed. Remember, fourth waves can always become more complex. It really wouldn't surprise me if we rip it right back up to where we were mid this week. That would be for a B, and a C. So please keep that in mind. We can still go a little bit lower, and we can even go below last Friday's low. It is possible. Fourth waves can be very tricky. I want you to be aware of that. So far, we could have done an A, and now in wave B, and then wave C up again, and then we go lower. Okay. Please remember that the wave 3 here in the cash market fell about 2% short of the ideal target zone. So far, so good, reasonably okay. Futures market got even closer to the 123.6% extension. Now, the issue I have here is that although in this case wave 3 is longer than wave 1, it didn't really reach the ideal target zone of 138.2 to 161.8, which is a little odd, but therefore I need to think that we might still be in a 1 degree lower fourth and fifth wave. Allow me to explain. So here's the hourly chart of the S&P 500, which I haven't shared with you for a while, but actually I haven't really changed too much about it. And you can see the red Fibonacci extensions for the A1, B2, and then C3, 4, and 5. So normally the third wave bottoms around 161.8 to 138.2. Okay, just as I showed you here for the green 3. It's just a different wave degree, but it's the same. The third of a third wave, in this case in green, bottoms between the 100 to 123.6. Then the fourth of the third wave goes to about 76.4, etc. How do we know that? Well, this has kindly been provided by the folks at ElliottWaveTrader.net, Avi Gilbert's website. So these are the 2 standard impulse patterns that we're tracking. And those are also available on my website, okay? No, I don't want to update my password because I don't have a password. Let's go to my website. hopefully it's loading. We go to education. Okay, go to the education section. It's a little slow today, but here we go, Elliott Wave. And what do we have? The third of the third wave is between the 100 and 123.6. The third wave, 138.2. The fourth of the third wave to between 61.8 and 76.4. That is so far what we've got exactly, okay? It could be the third wave, but the third wave itself is kind of short. Something feels off, okay? So we've applied what we found on the web and boiled it down into one plot on where we should expect the third of the third wave, the fourth of the third wave, etc., based on ideal standard Fibonacci-based target zones. Now, what has bugged me also on the futures market is this decline here. The decline into late September is, in my humble opinion, 3 waves, A, B, and then this C. And the rally into, I would say, yesterday's or the day before's high midweek is 5. So this starts to suggest that this was a irregular, expanded flat wave 4. The third wave was okay to a little bit over the 100% extension, and then we had a rather complex wave 4. It wouldn't surprise me. So this wave count now has us almost complete wave 1 of wave 5 of wave C/3. We'll soon see a bounce, probably Monday, Tuesday. Ideally, fill this gap here at around 32 or 3700, 3725-ish, and then 3, 4, and 5 lower. As you can see, if we go to about 3725, the ideal Fibonacci targets for 3, 4, and 5 of 5 get us right to the 161.8% extension at 3406. That completes 3, and then 4, and then 5. Okay, that is shown here. So we have then wave 3, wave 4, and now in wave 5. And that will get us into this ideal 3410, 3515 target zone. Okay, just as I showed you here. That will get us there. Again, we are a little bit where normally the third wave would reach the 123.6, right? That's what we found here, this third wave. Now, if it doesn't, then often the B wave of the fourth wave does the trick. Seen it many, many times before. Then this is wave 3, this is A, this is B, and this is C. And now in this wave 5, it's going to subdivide lower to 3515, that's where 5 is 1, or 3410. That's wave 3 of C, and then wave 4 and wave 5. So as you can see, this wave count is 1 degree further away from a bottom than this wave count. However, both point ultimately to the same target zone. Here we're looking for about 3200, 3300, and here we're looking for also the same ideal downside target zone. So the downside targets are the same. So once we've reached those downside targets, it's time to become definitely more cautious from a bearish perspective. But I want you to be aware of this. Then we had a very simple wave 2 and a very complex wave 4. Again, this looks good for a 1, 2, 3, 4, and 5, just as I showed you here. There's nothing wrong with it. So once we see the breakdown below the bullish cutoff, which is last Friday's low, I'm going to look for 3200, 3300, and you see the ideal downside target zone. With, of course, the caveat that we could, sorry for the clicking around, could get this more complex wave 4. Because remember, average seasonality for a midterm new Democratic president has us rally into mid-October, bottom in late October. Now, we don't have to follow this path, but as I showed you in a previous update, let me see if I can find it. I'll show you I think that was Monday's update. Please give me a second. And Monday was on the 3rd. Let's see here, this seasonality chart, here we go. This was what we were looking for, remember? So we had the seasonality, so this would then be a more drawn out wave 4 and then the wave 5, okay? So that is still possible. If we get a more complex wave 4, then I'm all aboard, and we will drop this potentially more subdividing wave 3 Okay, so please keep that in mind. I want you to be cognizant of this fact, and we do want to align different lines of evidence as well to make sure that we're not going to get caught on the wrong side of things, where we might think, all right, the B wave is underway, and we still get a big fat drop, right? That's a 400 point drop. Don't want to miss it. But once we get into this target zone, especially if we go to 3,200, 3,300 more directly, it is time to get very cautious from a short perspective or from a bearish perspective. Okay, so I just wanted to make sure. So to sum it up, I like the charts on TradingView as well. There you have a nice little commercial for it. 1, 2. Potentially wave 3. Again, we got to 35.60 in the futures market. So technically, we've done enough. Wave 3 is longer than wave 1. And we went to 176.4% for wave 4. And then a 5:1 relationship targets this 3,300. If we go rather immediately to that level, I consider the entire decline since the August 15 or 16 high complete. If we kind of stall here at around 3,500, then this green arrow comes into play. That will be the alternate count. And then I think we're going to move back up here again to about here. And then we're going to go there. Okay, so those are the two alternatives, I think, from this perspective, with, of course, the third one being a more complex fourth wave. But the complex fourth wave still fits within, we still need a final fifth wave lower. Just wanted to point out that from a Fibonacci perspective, things fell a little bit short, so to say, on where third waves should bottom, where fourth waves should top. We've done technically enough, okay? So this counter trend rally was 4 days, and this was also 3 days. So technically, it's enough. And if we can get this impulse going, so if we get a 1, 2, and a 3 setup, I'm all on board. And then we have a look on where we're going to bottom. Is it around 34, 3,500 or a little bit lower? That will make the difference. So another person who is sniffing out the potential third wave lower as well is in the 3,400, 3,400 range is by Pretzel. So that also gives me reservation to if this will be all of wave 5. Okay, so that gives me a bit of a reservation. So that would support this alternative count in green, and then we bounce and then we get 5. So please be aware of it. Pretzel, great analyst, definitely perma bear. But so when perma bears see more downside in a bear market, they're definitely to be listened to, so to say. So that's what I want to track. For now, this remains the preferred path, a direct path drop lower for the final wave 5 of this decline, with the alternative it being that we'll only complete wave 3 since the August 16 high. Then we get a 4, and then we get the 5. And then the last alternative is for this more complex, drawn out in blue ABC. All right, can always become more complex, but we need to pretty much see it go straight back up to Wednesday's highs. That's the alternative of the alternative, so very much lower odds. But that's the interpretation of the chart. And so far, the market hasn't disproven this blue path since I put it on the map. Okay, I hope it's clear. I don't want to spill more beans on it using all the other indexes. I think this is quite good. Eventually, we still will get this larger bounce back. Now, I also wanted to share a very good interview by Zachary Manes from ElliottWaveTrader.net, who is now also much more on board with the supercycle 4-wave. I will send you the link, have a look at it. So also they are now more moving towards that idea, which I already posted in June, right? Already since June, I've been preferring this to be this larger supercycle 4th wave. Great interview. So bigger picture wise, that would then complete wave A. Then we get the big bounce B, C, cycle 4. Then we get cycle B, and then we get cycle C for supercycle 4. Okay, so Also, he says then that we can still go to 5,000 in the cycle B wave for a irregular expanded flat wave 4. Exactly the same as I said. You're just 4 months behind the curve. No, that's fine. That doesn't matter. The idea here is that great minds think alike. They're seeing it as well. So please be cognizant of that fact. Or as Avi Gilbert himself once said, he is a bull at heart. So when a bull at heart gives a bear warning, you better take it very seriously. It's different than a perma bear gives a bear warning, right? Or if a perma bear gives a bull warning, you better listen very closely, because those are really counter one's, I would say, ingrained character. So also they are now starting to consider that we are in the super cycle fourth wave. I think considering everything that's going on in the world, it is a very good idea. And shorter term as well, here's the intermediate term. This is still an option where we can have a bottom here, and then we get the big B wave bounce. So also here, we're trying to figure out exactly when and how we're going to bounce. If we're going to bounce 3950 to 4300. All right, let's see what I have on the map. 4050 to 4500. Not too bad. So again, this is from the book chapter Great Minds Think Alike. Also, they are moving in the camp we're in the super cycle fourth wave. I think that's a very fair assessment considering how long price has been below the 200-day moving average. That is not behaving in an impulsive fashion to the upside. All those good or slash bad things. So then that's the big picture. And then intermediate term, we can still bounce, as I said. So also there, once this downside level, the downside move since the August 16 high completes, expect a very big bounce. All right, lots of money to be made on the long side from things. For now, I prefer to look lower, either for 5 of 3 or all of 5. Looking at market breadth, the new lows are still too high. We didn't even get below 50 on this midweek spike, so it's still too high. Supports lower prices. Let's have a look at market breadth. It's negative again, but I think we might start to look for more positive divergence developing on the McClellan oscillator for the S&P 500. So midweek spike was only to 20. That is not sustainable. We need to see it go over 100 to start to suggest for a new kickoff wave. Although in this environment, if we go over 100, it's rather exhaustive. So in a bull market, over 100 is a kickoff wave. In a bear market, over 100 is exhaustive. And in general, any spike to 20 is meaningless. And we now have to wait and see if we can get more positive divergence going. I want to look here at the put-call ratio. It is trickling lower and lower. There's no buy signal really on it just yet. And if we keep trickling lower, please remember we're getting extremely low like we were in March. So then there are at some point way too many puts in place. Okay, so this is the moving average. We're getting quite bearish from a put-call ratio, but no turn, just as a reference. Lastly, the PMO buy all sell all. It did give us buy signal on Wednesday, which of course has not been confirmed. So let's see how this is going to go. We do get a buy signal, so that's the only positive one. But again, this is not a fail-safe indicator. It just helps us tell if things are kind of stalling out in one direction or another. And in this way, we might be stalling out to the downside and maybe get a few negative or false signals. Every indicator has false signals that are not going to get followed up. Just like the MACD here, for example. The MACD gave a buy 2 days ago, and look where we are now. It happens. It gave a sell here in mid-August. That was great. And now it gave a buy, and it wasn't great. So not any indicator works sometimes. Or put it differently, all indicators work sometimes, and there's no indicator that works all the time. So here's the count for 3, 4, and 5 lower. Please keep it in mind. All right, forewarned is forearmed. It would fit much better with the Fibonacci extensions, etc. But can easily be already in this wave 5, which is going to simply subdivide lower into the 3,300 range plus or minus 100 and be done with it. Once we get there, I think it is time to really become more cautious for more downside, because then all we have left is this potential last wave 5. right? So have a look at where we are. If we're going to stall here at around 3,400, then the downside is about 100 points, maybe 200, and the upside potential is almost 1,000 points. So please keep that risk reward in mind. I hope you enjoyed this video. I hope you enjoyed the critical thinking of, wait a second, are we right in the wave degree? If everybody is thinking that way, maybe not. We do have the Perma Bear, no offense to Pretzel whatsoever, great work, thinking this is indeed only a wave 3, so we might need the 4 and the 5, okay? And then seasonality be damned, it would still fit because then we rally in November and we still have a drop into late November. So we don't necessarily have to have this drop on average go below that of October. This is just an average, but then we still see a drop. So for now, it still looks like we're going lower. Lower remains the preferred path, also because price is below the Ichimoku cloud. It is it's below the simple moving averages, all that stuff. So the pressure remains to the downside. I hope you enjoyed it. Watch the video with Zachary Manas. Lots of good stuff. Take care. Trade safe. See you all next week. Bye.